QuickBooks Pro Plus Desktop 2022 OneNote presentation, Bank Reconciliation Month 1 Overview. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introduction 9040, Bank Reconciliation Month 1 Overview. Also take a look at the Immersive Reader tool, topic introductions. They're in the text area too with the same name, same number, but with transcripts. Transcripts that can be translated into multiple languages and either listened to or read in them. Same name and number as presentations as well. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations, and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're looking at the bank reconciliation process, starting with the home page. Remembering that the bank reconciliation is going to be comparing what we have on our books to what is going to be on the bank, and that what we have in our system will typically not match what's in the bank unless you are dependent on the bank to create your books, which you might be under certain conditions. There's pros and cons to doing that. We'll go into a situation like that when we get into the bank feeds section and talk into that in more detail. But if you have an accrual kind of component that is going on, then you're going to be entering data into your system, and the bank's going to be doing their thing, entering your data into their system, and then the reconciliation process is the comparison between the two separate sets of books that are created separately but are recording the same information with regards to the bank that are then compared to each other. That comparison of two separate data inputs gives you that external control, which is a huge internal control not only over cash, but over the rest of the accounting system, given the fact that cash transactions are the lifeblood of the business. There's a double entry accounting system. Every transaction has at least two accounts impacted. Therefore, if you can double check all of the cash transactions, you're also getting a verification on these other cycles, vendors, customers, employees, and on other accounts on the balance sheet and the income statement. So what we're going to do is we're going to look at the checking account as of a point in time, the end of the month, because that's when the bank statement, we're going to have it January 31st here. We're going to compare that to what's on the bank statement. Typically, those two things will not match up. If we're entering a full service accounting system, we're entering the data separate from what the bank is doing because of timing differences, if nothing else, meaning there's going to be items that we know about, like checks and deposits that we put into our system that the bank does not know about yet. They haven't made an error. They just don't have it cleared at that point in time. Those are going to be the reconciling items. Now, if we can reconcile them, it's not just so that we can see that this ending balance is correct. It's often that we get the impression that why are we doing the bank reconciliation? To make sure cash is correct, and cash is super important. That's true. But what we're really trying to do is look at all the detail within the checking account to see that the activity is all in there correctly, because that gives us verification not only about the ending balance, but it also gives us verification about all the other sides of the transactions which are impacting in some way, shape, or form the other cycles and the construction, therefore, of the rest of the financial statements. So it's going to be a huge internal control. So how do we do that? We go into the banking dropdown, we go into the bank reconciliation, and when we do the first bank reconciliation, this beginning balance becomes a problem for us oftentimes, and we'll get into that basically in more detail. But notice if we compare this information to the bank statement, the beginning balance is different here. That could be because the last system you were using, you had outstanding checks and deposits in the last system. We had to enter it into our books at whatever the balance was in the checking account, which was $25,000, which was different than the bank account at that point in time due to the outstanding checks and deposits. We'll get into that more detail later, and then we're going to have to enter the ending balance here, and that's going to be coming from the bank statement. This is our mock bank statement that we're imagining comes from the bank, has the beginning balances, the additions, the subtractions to the ending balances, and then the detail, the deposits, and the checks to support that. Here is our bank account. We're going to try to go to that opening balances in the bank account and see this is where you might adjust that opening balance, but you got to be careful to use that opening balance. I often sometimes just like to use a journal entry to kind of adjust this item here, but we'll talk more about that again later. So we got the ending balance that we're going to put in place, and then we move forward. This is the reconciliation process. Now notice this process of doing this is not the bank reconciliation. The bank reconciliation is the report that you will be generating after you do this process. This is the process of reconciling, which we're just going to take all the information. This basically is our general ledger account for January for the checking account, and just tick and tie it all off compared to what's on the bank statement, which looks tedious and is kind of tedious, but it's actually quite easy to do, because if we had the correct beginning balance, which we don't right here, and we'll get into that, that's why the first bank reconciliation is a little bit more detailed, but if we had the correct beginning balance and we checked off all of the stuff that cleared, then we would get to the same cleared balance, and it has to work, right? Because we're just ticking and tying off the same numbers on the books and the bank. The way we want to do this is typically to go from the bank statement to the books. So we're going to go to the bank statement. Here's 65,000. Here's the books, 65,000, and tick and tie them off. We're not typically going to go from the books to the bank statement. We could, but notice that the reason you want to think about it in your head is going from the bank statement to the books is because everything on the bank statement needs to be in the books. And if it's on the bank statement and it's not in our books, then we have to fix our books, most likely, unless the bank is wrong, which is not usually what happens. What usually happens is we made an error, or we didn't know about something that's on the bank statement that's not in our books, so we fix it by adding it to our books. However, if something's on our books and they're not on the bank statement, that then most likely is not an error, or may not be. We're expecting that to happen, because those are the things we know about that the bank doesn't know about because they're outstanding, like checks and deposits that we wrote or deposited but haven't cleared the bank yet, because it takes time for those things to clear. So that's going to be the general overview, and we'll go forward. We'll do this in like a step-by-step process in future presentations.